Good evening, Futex traders, and welcome to everyone out there listening in on the Futex live stream. Very briefly, our focus points tonight, we're going to have a quick look at the weekly calendar. We're then going to move on to last week, and we're just going to have a look at a bit of a nutshell summary of last week. We're then going to talk about the markets on the move, them being the Shanghai Index, the VIX, the gold market, the yen, the euro dollar, and then the US and European bonds. And then we're going to just talk briefly about this idea of the bond conundrum, which I think could take center stage this week in the market. So let's head straight into it and have a look at the weekly calendar and try and assess where the weekly risk events lie. So very briefly on Monday, as you can see, no major data, nothing really market moving. In terms of risk allocation, a very small risk allocation. For those of you that are new to the Futex Live or haven't done a sort of a weekly roadmap with me, the risk allocation is just simply, if we were to take a whole week together and allocate our capital according to each day, this is how we would try and allocate. And the reason we do it this way is because it helps us to manage, to sort of roadmap our week, accordingly, and not be too aggressive on a day when the opportunities are going to be fewer. So that's why we do this risk allocation. Let's move on then Tuesday. Tuesday, as you can see, a little bit more data. We started with the German IFO. We then have in the afternoon the Case-Shiller housing data. We then have probably the highlight of Tuesday, which is the US consumer confidence. Now, very important. It is a highlight simply because it is probably one of the more important data pieces for the Fed. So that will be very closely watched and will definitely bring some volatility with it. We then have the new home sales and the Richmond Fed manufacturing data. So as you can see, a little bit more data on Tuesday, a few more risk events. And accordingly we allocate a little bit more risk as there's more likely to be volatility around particularly those releases. Then on Wednesday we've got the US durable goods. Now note, in years gone by, the durable goods used to be a relatively important number, but ever since we started getting very, very volatile swings in the number, the use of the durable goods is more a factor for GDP data, and the market, whilst it does move the market, it's not really an easy tradable opportunity. So again, durable goods is important, but as you can see, not too much risk allocated around the Wednesday. And then Thursday we have the second read of US GDP data as well as the pending home sales. Now again, very important, this is a second read of Q2 GDP for the US, and what I would say is that the US has a tendency to have very big variances between their first, second and third read. So pay attention, this number will definitely move the markets, particularly as the market becomes a little bit more sensitive to any data that the Fed may be watching. As you can see, only one risk event, but we're allocating a lot more risk. What I would also say is traditionally, Thursday tends to be bond moving day. So on Thursdays, we tend to get some really, really good bond moves. So keep an eye. That's why I've allocated a little bit more risk for Thursday. And then Friday, we've got again the UK GDP. This is also a second read of Q2. It can also, differ from the first read. So pay attention. And then we have what is easily the highlight of the week, the US core PCE data. This is probably the most closely watched data for the Fed. It gives them a real sort of direct understanding of of consumption and expenditure from the consumer, as well as the the US income and spending data. So please guys, Friday, that's a key 1:30 p.m. British summertime. That is the key data release for traders worldwide. And then we obviously have the month-end flows for the UK. Monday is a UK holiday, so pay attention, guys. We will see some flows going through. We could very likely see some FX flows going through as they settle on the 4 o'clock fix in the afternoon. So again, we allocate 25% of our weekly risk and 2 key events. So that's a wrap up of the week. It gives us a very good overview of how we're going to sort of navigate our way around some of the key risk events this week. Then very important, guys, also make sure you summarize the conditions. Try and give yourself a little bit of a brief, almost like a synopsis of a story about how the markets are trading, and give yourself this protection. It's so important to have these little one-liners. So let's go through them. The first thing I've said is UK holiday on Monday the 31st of August. Now the reason I point that out is because typically as traders, we expect month-end flows to come in on the last day of the month. But as the UK is such a big market player, it could very well be a case that we start to see a little bit of month inflows actually on Friday as opposed to Monday. So just bear that in mind, because the pattern might not exist as we are used to it, simply because of this holiday from the UK. So the second one is equity markets have become thin and volatile. Panic flows. VIX moved from 15 to 28. So important, guys. We saw this Thursday and Friday. Pay attention. If there's one thing I can say, be very careful this week. The dynamic of the markets has changed. By panic flows, I mean the bid and the offers have thinned out completely. Smaller sizes moving the market. And the reason I want to point that out is because if we look at this last point here, where I've spoken about a lack of liquidity, potential for a crash, all right, when the markets become thin and volatile, and the markets are very one-sided as they have been for so long now, a lack of liquidity creates the potential for a crash. I've then gone on to say something interesting, and I want you guys to take this to heart and just pay attention. Careers are built over time and ended in a day. Expect the unexpected this week. Now, the reason I've said that is not to scare people, it's just to open people's eyes to the potential that we could see some really, really spectacular moves this week. And I don't want people to sort of be shut off to the ideas of major market moves, guys. Please be aware this week. We saw 5 million contracts, or just shy, trade in the S&P on Friday. That is significant. It doesn't matter what training you have or how much experience, just pay attention. It is significant. Something as big is coming this week. So just take that to heart, keep that in mind, and obviously we will have a look at this VIX as we go a little bit further on. And then the last thing I just wanted to point out, the bond markets are not responding in typical risk-off fashion. So important, guys. If you haven't picked up on this, pay attention. The bonds should have rallied last week. The bonds did not rally last week. The bonds barely budged last week. That's crucial to understand, because it's going to give us a potential opportunity for this week. So that's the weekly calendar and the risk events. Let's then move on and just have a quick summary of last week. So as you can see, blood across the equity markets. I've got the S&P here down just shy of 5% on the week, and the DAX down just shy of sort of 8.5% down on the week. And just note that underperformance by Europe was seen for most part of the week, Monday, Tuesday, Wednesday. With the US markets then catching up a little bit on Thursday and Friday. So there's definitely a little bit more weakness in Europe. However, don't forget, with the ECB, doing QE and backstopping, don't be surprised if we start to see, this underperformance switch around, and the US start to underperform Europe as we go forward, as you get, sort of pension funds and portfolio managers looking to play the QE European trade. Then looking at the currency space, the euro dollar was up 2.45%. Now, I know a lot of retail traders are scratching their head saying, why is the euro rallying if Tsipras is resigned, and if what's going on? And very simply, guys, we've been talking about this theme for months now. Ever since the Greece crisis started, the euro is a safe haven currency now, just like the yen, just like the gold. In times of panic, money will flow into Europe, and couple that with a technical backdrop, which we'll have a look at in a bit, you'll understand why the euro is so well bid. The yen up just short of 2% as expected on the risk-off tone. The dollar index is down over 2% now. That's quite significant, guys, and we will have a look at the chart very briefly, but very significant in the sense that, don't forget, we have a looming interest rate hike potential coming in September. So to see the dollar weakening it's frightening more for anyone that's bullish the market, simply because everyone is bullish. There's a very, very big long position in the dollar space. So if we start to see the dollar sell off a little bit more aggressively next week, you could see some very aggressive stops as people liquidate their long positions. And then the interesting one is US bonds were only up 0.9%, with the German Bund up 0.6%. And we will come back to that in a minute, but just pay attention. Typically what you would see is, when you have such aggressive equity down moves, you would tend to see these bonds far more aggressively bid than what they did during the week. And then the commodities, oil's down another 5.5%. We've been talking about this for weeks now. It is one-time framing. That's the 10th week in a row oil has sold off. So again, guys, pay attention. The commodity space is showing very, very much weakness, particularly in the oil market. And then gold up just over 4% on the week. So again, that risk-off play coming into factor there, and very, very strong week for gold. So as you can see, if I was to summarize that week, very much risk-off across the board, guys. Bear that in mind, because risk-off plays don't just last 1 or 2 days. They tend to continue over a period of time until there's stability, or until stability can be given back to the market effectively. So that's the previous week in a nutshell. Let's then turn our attention and go through our key markets on the move. And the first one is the Shanghai Index. Now, the reason I spoke about this quite extensively on the Friday wrap-up, and the reason was because we're approaching this 3507, 3505 area, which is where the Central Bank of China stepped in fundamentally to support the market. They stepped in with measures where some of these state-owned companies would not sell their own shares. And we've then also seen them devalue the yuan, and in essence, all we've seen is just, again, a continuation. It's bounced once, it's bounced the second time on China's central bank support, but now we're heading back to that initial point. And if we take out that 3,500, guys, don't be surprised to come in on Monday morning and see the blood across the Asian markets. Another maybe 4 or 5% down day for the Shanghai. Just keep that in mind, guys, because that is a key support now, key psychological area for the market to pay attention to. So that's the Shanghai Index. What I would say is, as traders over the last week or two, what we have been doing is coming in the morning and leaning on Asia, leaning on the Shanghai, the Nikkei, the Hang Seng, the yen and the gold, and the overnight S&P to just sort of get some sort of an idea of how Europe might open on the day. So that's effectively the Shanghai Index. Let's turn our attention to the VIX. So again, this week, what I do want to point out is obviously the VIX hasn't been a good barometer. Not many traders have sort of utilized the VIX over the last couple of years because it's been so stagnant. But what I would point out now is, on Thursday and Friday, we very quickly rallied up to sort of, this 28 level, which is now the highest since 2000 and, back into 2011, 2012. So, pay attention. The VIX is showing some signs of scariness. If you get back up to this 43, don't be surprised if, the S&P is trading somewhere around 1900 or, and is very aggressively offered on the day. So that's the VIX index. Pay attention to that as it could be quite important going forward. Let's then have a look at the gold. So important, a great week for gold. It's very, very strong on the week. It not only did it get above that sort of previous, low back end of last year of 1131, it also skyrocketed above that sort of, with that resistance trend line we've been talking about around that 1160 mark, and it got all the way up to sort of 1169. So what I would say, early doors next week, don't be surprised if sort of 1155 it plays good support in the market. Gold is going to continue to find a bid in this risk-off environment, and don't be surprised to see us get back up towards this 1225 mark pretty quickly, as the entire market, sort of anyone who's short now will obviously be getting stopped out, and anyone who's looking to get long will buy it on the way up aggressively. So that's the gold market, looking very, very well bid at the close of the week. Let's turn our attention to the yen against the dollar. And again, the reason I point this market out is, twofold. One, obviously we know the yen for a long, long time has been in a, a very, very sell-off type mode, with yen being weak on the fact that they're doing more QE, and, the US is going to likely hike rates well before Japan. Now, what I want to point out is that there's almost been, you can see here, if I was to draw some sort of a line, you could actually see this very strong little, higher lows, higher highs, just constant little higher lows, higher highs. So the reason I want you guys to pay attention is because that makes this 128, 120.38 very, very important, because anyone who's sort of long until the trend turns or until this, channel turns will then effectively liquidate very aggressively once we get below that 120.38. So that for me is a key level in the yen. I would definitely be looking for long only, or in this case short dollar against yen, but long yen against dollar. So I'd definitely be looking for move down to this point this week, and then if we get below there, a very, very fast aggressive move, in maybe the next couple of days and week, back down towards this 115.5. So pay attention to this market. It is a market with a lot of longs. There's not too many people that would effectively be betting against the dollar, against the yen. So pay attention to that market. Could give some really good opportunities. Let's turn our attention to the euro dollar then. Effectively, again, a very neat market. We know we've been in this downtrend from 140 all the way down to this 105. We know there's so many shorts in this euro dollar space. So what I want to do, guys, is just point out we get above 114 and we confirm a close above 114, and it's game on for a move up to 117 very quickly next week, Monday, Tuesday, Wednesday, particularly in a risk-off environment. So, we're about to break this wedge. There's a lot of people looking to liquidate, dollar positions, and with the risk-off factor coming into play, as well as this being very much an oversold type market on the QE play, I wouldn't be surprised we get above 114.5 and 117.5 trades, Tuesday, Wednesday very early. So keep an eye on that. It's a wonderful wedge little formation. It is technically very, very good, and it is now fundamentally, with a risk-off, a very, very strong trade to be looking to take part in. And then let's turn our attention to the US bonds. First bond I want to get out, probably the most significant bond. If you're a bond trader, make sure you're always watching what the back-end bonds are doing, the 30-year, because they tell a very, very unique story about the future path of rates, future path of inflation and growth. So what I want to point out, and this is where I was talking about how the bonds did not respond this week, is that effectively we've had an inside week in the bonds. Now, that's very, very unusual, guys. In the 4 or 5 years I've been trading, I've never ever seen the bonds respond this way, where equities are dumping in a panic type fashion and the bonds do not even respond at all. I mean, what we're talking about here is a 7 basis point move in the US 30, and that's not normal. And as traders, we have to pick up when the pattern changes, when the game changes. Now, the reason I'm pointing this out is because in a minute I'm going to show you another little chart, and what I'm sort of leaning on is, if the equities find some sort of a bounce, and it probably won't be Tuesday, maybe Monday, probably somewhere around Tuesday, Wednesday, they might consolidate and bounce a little bit. But once they bounce, you may find that people start to then look to sell the bond markets. And the reason the bonds are not rallying is twofold. One, I don't think anyone wants to be long bonds at these yields with the given backdrop of potential rate hikes. But equally, I think there is someone sitting in those bonds actually selling them. So someone's utilizing the risk-off environment to actually get short bonds, and that is significant, guys. That is something you must pay heed to, because if we take out this 2.9, whether it's this week or next week, it's going to be a very quick move up to 3.2, particularly if everyone's trying to get long the bonds on this risk-off environment and price is not responding. So pay attention. 2.9 is key. Obviously, I want to see how we respond below 272 in the 30-year. But for me, I'm looking for a rise in yields this week, particularly when the equities bounce. Let's then have a quick look just at something important. We spoke last week. We spoke about how all the major financial market papers were telling us about this deflationary type play. Now, I just had a look at the US 5-year tips, and the reason I did this was I wanted to try and get a gauge or an understanding of whether or not the sell-off in yields in bond markets was as a result of global fears of deflation because of the slowdown in China, the slowdown in commodities, or is it being driven by a risk-off play? Now, this chart would suggest to me, the fact that the tips they've sold off a little bit, but not majorly aggressive, nowhere near the levels we saw back in April of this year, when we were having the real panic global deflation scare. And the fact that we're not really selling off aggressive in the tips suggests to me that the only reason the bonds actually rallied in terms of price and dropped in terms of yield was because of a little bit of risk off coming into the market. And so just keep an eye on this, because if this starts to turn back down, I wouldn't be surprised if you see those yields move even lower. But the fact that this is still up here suggests to me once those equities turn, it could very, very much be a quick move in the bond markets to the downside. And then let's have a look at the German bond yields. Again, we've got a weekly chart, and just note, guys, we a week where the market should have sold off in terms of yield far more aggressive than it did, yet it was just an orderly little sell-off, very, very slow grind higher in terms of prices, as though someone is sitting there on the offer happily taking bonds at these lower yields. Now, what I do want to pay attention to is if I get if I get this chart back up here, I just want to pay attention to, very early Monday morning, we are approaching this yield gap at 53 basis points, not so obvious to most day traders because they trade price. So just keep an eye on 53 basis points, but then more importantly for me, the key support, 47.5 basis points. The Bund should find a strong amount of support in yield, but resistance in price. So not much to go, maybe 60 or 70 ticks higher from the Friday close. Keep an eye on that area, guys, somewhere around maybe the 50s or 60s, 156.60. We get there. Don't be surprised to see some big players step into the market. Now, let's talk about this conundrum I've been paying attention to. And the reason I want to talk about this conundrum is, it could take center stage this week, particularly in the global bond market space. So what I have here effectively is the US 10-year representation on the last 3 days. Now, the reason I brought this up is because what I want to show people is that, most of last week's move in the bond markets was done on the FOMC. So on Wednesday night, when the Fed came out, they didn't say anything majorly new. but they sort of, the market took it as though, it's less likely we're going to get a hike in September. And as a result, we can see the US 10-year sort of dropped very quickly, sort of 10 basis points as it sort of factored out some of the probability of a hike in September. But since then, in other words, since that, Thursday morning when we came in, the bonds, the US 10-year only sold off another 8 basis points. Now, to compare that to, the S&P that sold off, 4.5% in 2 days, it's very suggestive of something is not quite right. These bond markets should have been doing, these Wednesday candles to the downside, given all the risk off. Now, that's the 10-year. Now, the second one I want to pay attention to is the 5-year. As you can see, the 5-year, very similarly. Okay, so we saw the unwind of a probability of a hike in September, and then 2 days where the US 5-year just barely responded. It's as though there's a lack of interest to be a seller of yield at these levels. And what that makes me believe is that there's no one interested in being short of these yields. Doesn't matter how much of a risk-off environment there is, no one's interested. So again, if we get a bounce in equities this week, what I'm leaning on is we could see a very, very strong sell-off in the bond markets going forward. Then, what I do want to point out, and this is the conundrum for the week and probably my highlight chart of the week, and I've labeled it the chart that says it all. Two things I want to point out. This is a historic chart going back to 2011. In the purple line, we've got the S&P 500. In the orange line, we've got the US 10-year bonds. And then in the bottom here, what we've got is the US 10-30 spread. Now, what I'm trying to create here is I'm trying to create a situation where every time we get a correction of 10% or more in the S&P, how do the bonds move? So what I'm trying to show you here is I'm trying to show you the typical traditional risk-off move that we would see when equities were correcting. As well as what the spread does at that time. So every yellow line now going forward, every one of these vertical yellow lines is a 10% correction in the S&P. Now, as you can see, going back, the last time we had a sort of a correction, on the purple line in the S&P, the bond yields rallied your bond yields sold off. In other words, prices rallied very, very aggressively. Again, in 2012, we saw a correction in the S&P, and again, you can see the US bonds sold off very aggressively in yield. And then again in 2014, the beginning of the year, we had a correction in the S&P, and note what the US 10-year yields did. Again in end of 2014, we saw a correction in the S&P, and US bond yields again sold off. And then the last one was January or late last year. We saw again a little bit of a correction in the equities and a response in the bond yields. Now, what I do want to point out is we now have the start of almost what is almost a 10% correction. I think we're at about 7%. The 10% correction comes in around 1935. So as you can see, we've almost done a 10% correction, but look how the US bonds have responded. There's a lack of response in these bond markets. There's a real lack of interest to be short at these yields. Now, again, what I'm advocating, if we do see a turn, we see a little bit of bounce or a little bit of bargain buying in the equities, don't be surprised to see US 10s get back to this 2.5% very fast. The second thing I wanted to point out, and this is where I'm going to leave it for this week, guys. Note, every time we see a corrective type move in the S&P, we tend to see traditional flatness. Now, in risk-off environment, you tend to see flattener trades being put on in the markets, whether it's 2s 10s, 5s 10s, or 2s 30s, whatever it may be, you tend to see flatteners, as can be illustrated by this 10s 30 flattener trade I've got here. Now, what I wanted to point out, and this is where I'm going to leave it, if we look effectively at this week, and we take this representation, this is effectively, this is effectively the 5-10s spread. You can see not only did the chart not flatten over the course of the week, it actually steepened. Now, guys, that is as a sharp a clue as you're ever going to get as a trader. If a market in a risk-off environment steepens instead of flattening, it's telling you there is someone sitting in these bonds short in the market. I cannot say that enough times. If you want any kind of a trade opportunity this week, look for when the equities bounce to be short the bonds. There is someone sitting in these bond markets selling away, preparing for the looming interest rate hike coming potentially in September. So let's leave it there. Let's wrap up. Good luck this week. Remember what I said to you. Take it easy. There's no need to be too aggressive anywhere. Don't forget, careers are built over time. Experience is built over time. But as long as it takes to build that experience, it can be lost in a single moment of madness, a single moment of lunacy. So keep your head about you. Take it easy this week. Good luck, and we'll catch up next week.